Good morning, it is Sam here. I wanted to talk about my portfolio positions and their change for this week. Before I get into that, if this is your first time here, what's up? I'm Sam. If you're returning, it's good to frickin' see you. So, what I wanted to talk about in this video was what happened with my portfolio this week, both in terms of the market fluctuations as well as the positions that I opened, and what I'm going to be doing going forward. Because I lost over $400 this week on a 6,500-ish size portfolio. Okay. So now, with that being said, I wanted to give anybody who is new here a little bit of context to what I am doing. So I have always been fascinated by options, and I started trading them back on March 10th, I think, which was a Sunday, so it would have been the day after that, and quickly more than doubled my portfolio value in about 5 to 7 weeks, 6 weeks or something like that, up to about $11,400. And over the subsequent 6 weeks or so, I lost all of that and went back down to 3,800, which was all the gains I had plus 500 of my own money. So I was like, I need to rethink my strategy around risk. So I started considering the risk in the equation, and with the objective of just making, approximately $250 per week in profit. Generally speaking, the strategy I'm going to be using is weekly options, with some that are out further in the future. Like, as I'll touch on later on in the video, I have two positions that are more, well, one of them is for next week and one of them is in August, but I've held both of those positions for a little period of time. And every week I want to be able to take some funds off the table to help diversify the portfolio. So currently I have 6 shares of Tesla. So all the money that I take off the table every week is used to purchase shares. Generally speaking, I'll be purchasing Tesla. But every 5 to 7 weeks out, I will take the funds that I would have purchased a share of Tesla with, and I will purchase something else. This past week, on July 15th, I just took some notes here. On July 15th, which was Monday, instead of purchasing Tesla, I purchased Ford. Why the fuck would I purchase Ford? Like, what the fuck are they doing? Well, they have an amazing dividend yield. It's 7.8%. That's a crazy high dividend yield. And if you make the assumption that they're not going to go bankrupt and cut their dividend, which it could be a fallacy, that could be a completely inaccurate assumption, I don't see that happening in the interim, 12 to say 60 months, but a lot of shit can change in 60 months. So, purchased 22 shares of that on Monday. With the dividend yield being nearly 8%, if you look at the empirical research, companies tend to not like cutting their dividend. What that implies to the market, or how the market interprets that most of the time, that people who are looking at it, if it's well articulated, it could actually be a benefit, but the market generally interprets that negatively, because the interpretation from the market standpoint for the players in the market is that the company is doing worse off, so they had to cut their dividend because they're not going to make as much money. The outlook for the future is not as good, so they need to save money by cutting their dividend. That tends to be some variation of the interpretation of what happens in the market when a company cuts their dividends. So what companies are rewarded for is consistently keeping their dividend every quarter or 6 months or monthly. Most companies are never going to do monthly unless it's like a REIT or something like that. But keeping their dividend consistent and growing it over time. So this year, keeping it level, and then next year growing it by several cents per share or something like that. And what ends up happening is that I lock in that cost basis for purchasing 22 shares on Monday. So I locked in that $10.30 a share. Now, it doesn't tremendously matter what happens to the price of Ford per share, because if in the future they increase their dividends, my dividend yield will go up on a cost basis. So say they finally start to get their shit together, or Argo, their AI like cruise automation type company that GM has, it starts doing something intelligent. I mean, they're doing a lot of things intelligent, but starts doing something that creates revenue for Ford. That could be tremendous and allow them to increase their dividend in the future. I don't necessarily see a steep growth rate in their dividend rate in the future, but I do think that they have the potential to start getting their shit together. But it's going to take a little bit of time and effort for them to actually start doing that, because they've been going the wrong way for quite a while, I feel like. The next thing that I opened up on Monday was a Netflix credit put spread, and that was substantially below the market. I think it was 325 to 320 expiration today. This is when Netflix was, I think on Monday, was trading at around $371, I think, or something like that. Let me just take a quick. Yeah, $375 on Monday. And throughout the week, so I took in $90 of premium. Throughout the week, that kept drifting down. And then they had the earnings call on Wednesday night, and they missed their subscriber estimate for what they were due for quarter number 2, which, if you look at the past 4 years, they've missed 3 out of the last 4 years. So that was kind of like expected that their estimate wasn't good. Quarter 2 tends to be the quarter that they miss their estimates for some reason or not. Maybe something to do with seasonality and becoming from late winter to spring and summertime, and that having an impact because less people are out or watching movies and they're doing stuff outside. I'm not sure, but they tend to miss quarter number 2. If you look at the last 4 years of data, if you want to see a full analysis on that, check out the channel for the Netflix earnings call. Anyways, after hours on Wednesday, they had their earnings call, and that slaughtered that position. So the next day, the maximum loss you can lose on a credit spread, is the difference between the two strike prices. So as I mentioned, 325 to 320, the delta on that is $500. So if you take 325 minus 320, that's $5, right? $5, and then each option is based on 100 shares of the underlying being Netflix in this case. So you take $5 times 100, and that's $500. So that is the maximum amount that I can lose. And I had 2 contracts, so the maximum I could lose is $1,000, minus the premium that I collected. I collected $90. So the maximum I could lose on that position was $910. The next day, I was able to close out the position, and this was so after the earnings call, Netflix went from 363 roughly down to 321, completely slaughtered my position so that I would be at almost nearly the maximum loss. And I closed out that position at $558 the following day, which means that I lost $468 on that trade. Now, excuse me, I don't have the expectation that I would be winning every single trade. However, that is the whole reason that I'm taking money off the table. because there's things that happen and you lose a trade. So having a strategy associated with capital preservation and diversification of risk helps with the overall performance of the portfolio from a standard deviation standpoint. So closed out that position and that closed out that position yesterday. Now another position I opened up on Tuesday, so this is the next day, was Amazon put credit spread for $65. When I opened that up, I think the spread on that from Tuesday was around $100. So on Tuesday, it was trading around $2,020, and marginally over $2,000 per share. And then there was some trading down over the next couple of days until yesterday. The position substantially dropped down to 1958, 1957, which the position I had on Amazon is the 1960 to 1950. So what the fuck does all that mean? Well, I opened the position when Amazon stock price is here. And I opened the position down here. How this position wins and makes money is if Amazon stock price stays above this upper limit here where my finger is moving. So it can come down some, but as long as it stays and closes above this, then I can profit. So what happened, or goes up, right? Ideally, you want it to stay the same or increase. So what happened after I opened the position? Amazon just kept coming down, and then it was below that price, which means that I would lose. And the same thing goes to figure out the maximum loss on this is the delta between the two exercise prices. So this is a 1960 to 1950. That's $1,950 to $1,960, right? Because Amazon is around $2,000 a share. So the difference between 60 and 50 is $10. But remember, it's based on 100 shares. So that the maximum amount of loss I can have on this is $1,000. And I have one contract open. So the maximum loss I could have is $1,000. Currently, when the market closed last night, that position was losing $70. So what that means is if you take the $65 that I made or that I took in on the position and the current market value, you get the difference of $70. So currently it's trading at about $135 for this spread, which means that I would pay $135 to close out the position, but I took in 65, so the delta on those two, delta just means the change in something. So if I pay $135 and I received 65, the difference between those two is $70. So I would lose $70 in the position. However, when you look at what is happening pre-market, which just means before the fucking market opens, today, Amazon is back up at around 1990, so I would expect that this position closes. I could probably close it out profitably today. I'm not sure how much volatility will take place when the market opens, but either way, all that will do is help offset some of the losses that I took on that Netflix position. Now, as I mentioned, the two positions that I've held longer term are Tesla put credit spread that expires next Friday, and that's at 220 to 212.5. So the maximum I can lose in that, again, is the 220 minus the 212.5, $7.50. Times 100, $750. There's two contracts there. So $750 times 2 means $1,500. So the maximum I can lose on that position is $1,500. currently, since I've opened the position, it's I've made $140 on paper. So what that means is I say sold the position for $200, and currently now it's selling for $100. So if I wanted to close out the position, I could close it out, then lock in that $100. That's essentially what that says. Another position I opened up back in May, I believe it was, is the Tesla put credit spread for our 260 to 250. So that's a $10 spread. There's 2 contracts, which means a maximum loss of $2,000. And the reason I opened it up back then is because I had the expectation that Tesla would beat their delivery expectations for quarter number 2, and probably revenue and probably earnings for quarter number 2 based on what the market expectation is. So it doesn't really matter the absolute level of deliveries or earnings or revenue for a company. It matters what those 3 things are relative to the expectations. So if they are above expectations, then there is a positive movement in the price of the stock the vast majority of the time. If they grew, but they grew at 7% and the market expected them to grow at 10%, then that would be negative and the price would come down. A look at what just happened with Netflix. Check out that if you want to. So that position is up $100, which means on paper. So I sold it for like, I don't know, $1,000. And if I were to close out the position right now, I would make $100. So by doing this one so far in advance, the average credit I received, so I sold 2 contracts on this, and the average credit, the premium that I received was $555 per contract. So think about that from a break-even standpoint. That cuts the break-even down to $255. At the time, Tesla was trading at a much higher price, so it was below the market at the time, and then Tesla crashed. So the maximum I can make on this is like $1,120 or something like that. However, Tesla's currently trading at $255, so I would basically be making money if it were to close right now. But it still doesn't have, it still has over a month left, or just about a month left, which is August 16th. Why did I pick August 16th? Because I wanted to do it after Tesla's earnings call for Q2, and I didn't know when that was going to be. I was expecting it to be the first or second week of August. It looks like it's going to be this coming week, the 24th. So I'm just going to leave that position open and see what happens on the 24th. Maybe there's a big miss. Maybe I'm completely wrong, and I lose $2,000 in that position. But we'll see. Anyways, if you guys enjoy this content, make sure you press that thumbs up button. It really helps out the channel. It tells YouTube to share this video with other people who might find value in it. So I would appreciate it if you did that. If you got any value out of this video, if you want to see more videos like this in the future, make sure you press that subscribe button. Today, I will probably not be opening up any positions unless something drastic happens in the market. That's when I like to open positions, because I can get the biggest premium collection. But other than that, I probably will not open any positions today. I might close out the Amazon one depending on where the market moves. Current portfolio value is $6,353.09. So if you guys have any questions, leave them down below in the comments. I'm going to be completely transparent on what I'm doing and how I am trading, so that anybody else who wants to learn or do it themselves, like, investing is not that complicated. You can make it as complicated as possible, but I think a lot of people tell themselves this story that investing is tremendously complex and difficult to do. It's not something that they have any familiarity with, and just show that you can do it. By the way, I'm not by any stretch of the imagination recommending that you do any of the shit I do. The vast majority of people who watch this should probably only just invest in index funds. But just to give you some type of context, I'm just a regular dude That's it. Peace.